If you're an investor, I don't care if you're just starting out or if you've been doing this for decades, you've definitely asked yourself this question. Am I about to pay way too much for this stock? Or did I just stumble upon the deal of a lifetime, right? You're looking at a stock and you're wondering, is this thing a total bargain? Or is it a bubble that's just about to pop? That price you see on the screen, well, it's just one number. And honestly, it can be super misleading. So how do you actually look deeper and find out what a company is really worth? Well, you've got to hunt for its intrinsic value. That's the company's true price, and it's usually hiding just under the surface. And to find it, you need the right set of tools. Yeah, the pros, they don't just guess. They use this powerful toolkit, and it's filled with something called valuation ratios. Think of these as special lenses that let them assess a company's financial health and figure out if it's actually a smart investment. So let's crack open that toolkit, shall we? We're going to take a look at the essential instruments that help smart investors cut through all the market noise and see what a company is really made of. And that's really what these ratios are all about. They help you look right past that flashy up and down market price so you can understand the company's real underlying performance. They let you figure out if a stock is undervalued, overvalued, or maybe, just maybe, priced just right. We're going to break down 4 of the most essential ratios that, frankly, every single investor out there really ought to understand. First up, the big one. The one almost everyone's heard of, the price-to-earnings ratio, or PE ratio. You can think of it as the classic go-to tool for a quick valuation check. It puts the price you pay for one share head-to-head with the profit that share actually makes. And the math here is actually super simple. You just take the stock's market price and divide it by the company's earnings per share. What you're left with is one number that basically answers the question. For every single dollar of profit this company makes, how many dollars am I being asked to pay? So get this. If a company has a PE ratio of 100, that means investors are willing to pay $100 for just $1 of that company's profit. Wow, that's a huge premium. And it can be a big warning sign that a stock is getting way too expensive. So what's a good number then? Well, it definitely varies depending on the industry, but here's a pretty good rule of thumb. A super high PE can be a red flag, but a ratio somewhere in that 15 to 30 range, that's often considered the sweet spot, suggesting the valuation is healthy and, reasonable. All right, tool number 2 in our kit is the price-to-book, or PB ratio. Now, instead of looking at profits, this one compares the stock price to the company's book value. And book value is basically its net worth according to the official accounting books. So the calculation is the market price divided by its book value per share. The easiest way to think about book value is if the company sold everything it owned and paid off all its debts, what would be left for the shareholders? It's the company's value, on paper. And this is where it gets really interesting. If a company's PB ratio is less than 1, it means you could, in theory, buy the entire company for less than the value of its assets on the books. For a certain type of investor, finding a solid company trading below a PB of 1, well, that's like striking gold. But hang on, what do you do with companies that aren't even profitable yet? Like a hot new tech startup that's growing like crazy. That's where our third tool, the price-to-sales, or P/S ratio, is a lifesaver. It totally ignores profits and just focuses on sales revenue. It's another simple one. Just divide the market price by the company's sales per share. This tells you, really quickly, how much the market is willing to pay for every single dollar of sales that comes through the door. Okay, now hold on. Before we get to our final and maybe most powerful tool, we got to understand one key idea: enterprise value, or EV. The absolute best way to think about EV is as the true takeover price of a company. See, if you were to buy it, you'd not only have to buy all its stock, but you'd also be on the hook for all of its debt. EV captures that whole picture. Which brings us to our fourth tool, the EV to EBITDA ratio. I know, EBITDA is a total mouthful. It's earnings before interest, taxes, depreciation, and amortization. But here's what you really need to know. It's just a clean way to measure a company's raw operational profit without all the weird accounting or financing stuff getting in the way. And that makes it an amazing tool for comparing the core performance of 2 totally different companies. So it's pretty clear that finding a stock's real value means looking way, way beyond those daily price swings. It's about using these tools to put together a much more complete picture of the business itself. So let's do a quick recap of the whole toolkit. The PE ratio, that's your price versus profits. The PB ratio compares price to the company's on-paper accounting value. The PS ratio sizes up price against sales. And finally, that powerhouse EV/EBITDA ratio, that compares a company's total value to its core operating performance. Really, the whole point of this is to become a kind of financial detective. You're using these ratios like a magnifying glass, searching for clues that point you towards strong, well-run companies that the rest of the market might be, well, unfairly ignoring at the moment. But this all leads to one final and absolutely crucial question. If a stock looks cheap based on all these ratios, is that an automatic green light to buy it? Not so fast. Sometimes a stock is cheap for a very, very good reason. And knowing the difference, well, that's the real art of investing.